What's going on, guys? Welcome to the Hustle or Stay Basic channel, the Invest or Stay Basic segment. I'm your host, KG, and as you can tell by the title, today we are taking a look at Fortis. Shout out to Anthony Costel, who recommended me to take a look at this video. I hope you enjoy it, and let's get into it. So if you didn't know, Fortis is a Canadian utility company trading for a price of $51.53 per share with a market cap of $24 billion. They have 3.3 million electric and gas customers. Over the last 20 years, they've provided a 13% average annual return, and they have a 3.86% dividend yield, which is equal to $2.02 per share annually. Fortis hasn't taken that big of a hit because they're not heavily reliant on the oil industry, but it's still down 11% over the last 12 months. So what is Fortis? Well, Fortis Inc. operates an electric and gas utility company in Canada, the United States, and the Caribbean countries. You might be like, okay, that doesn't really tell me too much. Trust me, Yahoo Finance had a huge description, and it kind of leads to one of my pet peeves about utility companies, but I'll get into that later in the video. I think before we get into what they actually do, it's really important for you as an investor to understand how they make money. So let's find that out. So I got this really cool title here for you guys. How does the utility sector make money? And I got this situation here. Why would I say I'm the CEO or founder of a utility company? Why not? Why would I embark on a mission to create infrastructure without a guaranteed rate of return? Like, sure, it would help with communities and cities and towns, but what do I get out of it? I mean, I'm running a business. So that's where utility regulators come in play. They set what's called a regulatory compact. They essentially ensure that it's worth the utility's time or while to invest and create infrastructure. So I got a formula down here that kind of shows how they do that. The total revenue requirement is set by something called the rate base times the allowed rate of return plus operating expenses. So the rate base is basically the investments that the utility company has made. It's the assets minus the accumulated depreciation, and the operating expenses are the expenses associated with running those assets. What the regulators define is the allowed rate of return. So I'm making money while, helping the community and doing cool things like that. A lot of people have said that this formula is actually rigged for these utility monopolies because it doesn't prevent these utility companies from limiting their operating expenses. And also they can make all kinds of investments and increase that rate base, which in turn will increase their sales and their total revenue requirement. Sounds pretty rigged to me, but at least they got some regulators overseeing what's going on. If that formula was super confusing, I have a real example of a Fortis subsidiary that shows the rate base and the return on equity that they would be getting. As you can see, the subsidiary ITC has a rate base or assets minus accumulated depreciation of $9.4 billion invested here, and they get about a 10 to 11% return on everything they've invested. Cool, does this all make sense to you? Let's go take a look at sales. So Fortis has a really good business model, like I shared earlier. Basically, anything they invest into communities, they know they're going to get a return on. And you can see that by their last 4 years of earnings. Analysts are actually projecting that they'll do over $9 billion of sales in 2020, which would beat what they did last year. So I think that explains how Fortis has performed currently, but what's the future outlook like? As you can see, they have that very safe 93% of their assets is energy delivery related. And what they want to do in 2035, which is quite a ways away, is focus a little bit more on renewable energy and get away from fossil fuel generation. So this is super far looking, but hey, at least that's what their plan is. Another thing they want to do is increase their dividends 6% every year until 2025. So if they did that, their dividends would be about $2.70 a share. That would be an increase of 70 cents per share or over a period of 5 years. So if you bought today and held till 2025, you'd be getting a 5% yield at that time. I don't think there's any doubt that they won't do that, as they have 47 years of consecutive dividend increases. Another thing they want to do is they want to increase their rate base by $10 billion over the next 5 years. This is a jump from 30 billion to 40 billion. Of course, by increasing their rate base, they'll increase their total revenue requirements, which in turn will increase their sales over the next 5 years. So we got a 6% rate base increase and, a 4% dividend. We're looking at about 10% returns every year, potentially. So the past couple of slides I talked about, going into renewable energy in 2035, increasing dividends, increasing the rate base, all great stuff. This slide, I kind of want to talk about some of the things I don't like about utility companies and Fortis. One of the things I don't like about utility companies like Fortis is they continually take out debt to, create more infrastructure. And it's just a never-ending cycle of taking out debt, taking out debt, taking out debt. And it's long-term debt. So you can see they have $25 billion of debt and $494 million of cash. Case in point of this never-ending cycle of taking out debt is, $1.3 billion of debt, they paid back $1.8 billion. $2 billion of debt, they pay back 1.2. So in some instances, they're taking out more debt than they're paying back every year. I just don't like that business model, but I do understand why they do it. Another reason I don't like utility companies like Fortis is they have so much going on at any given point. So we have Fortis, we have ITC, we have UNS Energy Corp, we have Central Hudson, Fortis Alberta, Newfoundland Power, Maritime Electric, Fortis Ontario, Caribbean Utilities, Fortis TCI. These are subsidiaries of Fortis. And, they all have different return on equities. They all have different regulators. They all have different projects. They all have different rate bases. And it's a lot to keep up with. That's why I choose to invest in companies that are easy to understand and easy to follow, which a utility company just isn't. As a shareholder, I want the shares outstanding to go down. I don't want it to actually increase because that takes away value from me. And from 2019 to 2020, Fortis actually added 6% more shares outstanding. So although their sales are increasing by 3%, there's actually 6% more shares out there. Based on all that, I still think it's a really safe stock and it has a really solid business model, but it's really low upside short term. And you're probably going to get somewhere around a 10 to 12% return over the long term. So what do you guys think? Are you buying Fortis? Are you not? Do you agree with my analysis? Let me know in the comments below. Thanks again for all the subscribers. I believe we hit 100 now. That's awesome. Thank you so much. By the way, this is not financial advice. Go seek a financial advisor for that. But I hope you enjoyed my thoughts on this company. If there's a company you want me to take a look at, drop a comment below. I'll definitely take a look at it. And I hope you guys have a great day. See ya.